In this video, we'll be taking a look at the Z Energy company stock. Now, on the 6th of May, they released an announcement that they expect an increase in earnings for the financial year of 2022. So they will resume their dividend payment 6 months ahead of schedule, with a payout of 14 cents per share. Now, this comes after they cut their final dividend for the financial year of 2020 due to uncertainty over the virus and lockdowns. Now, this means you are looking at an annual dividend yield of around 10% if their share price stays at their current share price of $2.80. Now, if you want to get in on the dividend, you will need to purchase Z Energy shares by the 20th of May. But is this great value, or is it too good to be true? Or is this a potential dividend trap? First off, what is a dividend trap? A dividend trap is where a company announces a high dividend yield, usually more than 5%. So investors are like, oh great, that's such a good deal. So they put money into the company. But a lot of times these companies are not the most well-managed companies and are generally unable to increase their sales and revenue. So eventually, the company will start cutting their dividends again after a few months or years. And more often than not, the share price will decline again as well. This means that investors will end up holding a stock that's worth much less than they put in, and also not really getting much dividends due to all the dividend cuts. I think there's a very basic rule when it comes to finance, which is if something sounds too good to be true, then it probably is. Now, if an investment is offering you 100% returns with no downside, it's probably too good to be true. So what does this have to do with dividend companies? Now, let's say we have a free market that follows the rules of supply and demand. Now, if a company offers a really high dividend yield, let's say around 10%, surely everyone that's into dividend investing would go and buy that company, and their share price would increase, and thus lowering their dividend yield, since the dividend yield is expressed as a fraction of the dividend over their share price. In reality, that usually doesn't happen. Now, many of these companies that have high dividend yields have either very low share price, or their share price have not been increasing for a very long time. Let's take Z Energy for example. Their share price has plummeted since the lockdown of last year and have not recovered at all. Now, currently, their share price is hovering around the $2.80 mark, when many other companies on the NZX have fully recovered, or at least show some signs of recovery. The second concerning thing is that the current payout ratio for Z Energy is over 120%, according to Simply Wall Street. Now, this means that they are paying more than 100% of their earnings as dividend to the shareholders. Now, even if they have the most positive outlook for the year for increased earnings in the future, now, this is simply unsustainable to be paying so much earning as dividends. This also shows that the company might not have a clear plan to reinvest their earnings back into growing the company. The third red flag for Z Energy is that their earnings per share have dropped by 7% per year over the past 5 years. While 2020 has undoubtedly been affected by the virus, their earnings have been dropping from 2017 to 2019, and this was before all the lockdowns had happened. Now, this shows that the company has not been doing particularly well, regardless of all the lockdown and the virus that has been going around. If we look on Yahoo Finance, Z Energy have a PE ratio of around 25, which makes them slightly more expensive when compared to the overall market in New Zealand. And they have a return on equity of around 7%, which is considered low for a company. Now, one of the bright side is that they do have a current ratio of about 1, which means that they do have more current assets than their current liabilities. So I wanted to find out more information about Z Energy, the company. So I went through the latest Z Energy annual report, and oh my god, it's full of all these wishy-washy crap. Now, they have a table called the Director Skill Matrix to show the number of directors that have high and moderate capabilities in categories such as balancing legacy and growth or customer insight. I mean, sure, they may be important categories, but to me, it just seems like a lot of filler information without going into the meat of the real issues. In the same annual report, they mentioned the term dividend no less than 35 times, and that's close to once every 2 pages. And they also talked about the 14 cents dividend that they're going to pay out this year at least 5 times. It feels to me that they are leaning heavily on steering people away from actual issues and more trying to get people to focus on the dividend that they are going to pay out this year. Also, within the financial report, there is a graph comparing the total shareholder return between Z Energy and the NZX Top 50 Index over the past 5 years. So Z Energy significantly lagged behind the index in terms of returns, even when accounting for dividend reinvestment. Overall, even though Z Energy promises a high dividend return, the payout rate is simply not sustainable in relation to its earnings, and I do not want to be holding the stock in case they cut dividends in the future. Therefore, I will not be personally investing into Z Energy stocks. If you want to learn more, be sure to check out my reviews on other companies on the New Zealand exchange, and I will see you in the next video.